Hello, good evening everyone here, and I'm so delighted that all of you have found time this evening to come to this auditorium and join over the call worldwide. I'm delighted to inform you all that we had almost 409 people registering for audio conference. So we have, I do not know how many, but we had this morning, we had about 400 people, as Shakespeare said, world is a theater, we are all. And so I'm very delighted that we had a great response, and obviously the subject is of a great importance. And we've been struggling with this particular issue for quite some time. And I think today it's very exciting that we are trying to understand what this decision means to all of us. I have with me my colleague, partner, Bijal Ajinkya. She's here. On my left, people can imagine. And I have Mahesh Kumar. He is my colleague, again, especially international tax, and of course, he has also been a great help. And Dhruv Sangvi, both these kids have studied their LLM and other kind of stuff in Leiden and other places. And for a long period of time, they have been very helpful. Obviously, Bijal and myself have been working for almost 11 years now. So that's a little introduction. What are we trying to do today? As you can see, the title of this seminar and webinar, mix of the two, we are trying to see what this Vodafone brings to us. What kind of insights, what are perspectives, what is likely to be the impact? The decision is out. Okay. I just would like to tell you, we are going to discuss some 10 items today. First, you can look at slide 2, those who are on the phone or on the video. There are 10 items in front of us today. Number 1, the facts. Second, revenues approach. There are facts of Vodafone, complex facts, we'll deal with that shortly. What was revenues approach? What did Supreme Court decide? Third point is, what about respecting form of a transaction? We always have been talking substance and more substance. And it has often been a very confusing expression. Next, dynamics of cross-border holding structure. Means, what are the dynamics? How and what is the relevance, and how Supreme Court has looked at when you are holding structures? Item 6, what is permissible taxpayer behavior? The biggest problem in last few years has been, how do you behave? How can you decide? Everything is grey, opaque and stuff like that, because it's becoming very difficult not only for taxpayers, tax advisors and everybody else to, So I think, then how the court considered Vodafone Hutch structure as a legitimate tax planning tool. Okay, or it was a legitimate tax planning. On what basis did it say, and what are the nuances arising with that? Item number 8. What about withholding tax obligation on non-residents when they make payments to other non-residents? How court has looked into Mauritius route, has been upheld, as you all know. But what are the observations? What are the issues arise out of the observations of the court? And in future, what kind of questions will arise? What issues? So these are the 10 points we propose to discuss in today's session. After the session, we'll be happy to have your questions, and we'll be delighted to take anything that you like to. Let's go back into the history, the value system of our taxing jurisprudence. Interestingly, we look at England for much of our jurisprudence. There is an equal plethora of cases in the US as well. And the thinking process is somewhat similar. Okay. Learned Hand Justice, in the case of Commissioner versus Newman, it was in 1947. What did this judge say? An interesting observation. Many of you already know about it, but it would be interesting to revisit. He said, anyone may arrange his affairs so that his taxes shall be as low as possible. He is not bound to choose that pattern which best pays the treasury. There is not even a patriotic duty to increase one's taxes. Over and over again, courts have said that there is nothing sinister Over and over again, courts have said that there is nothing sinister in so arranging one's affairs to keep taxes as low as possible. Everybody does so, rich or poor, and all do right, for nobody owes any public duty to pay more than the law demands. Taxes are enforced exactions, not voluntary contributions. So it is not a charity. To demand more in the name of morals is mere cant. So this has been said in 47, of course. This was a US court observation. We have over a century of jurisprudence, as you can see on slide 4. Almost a century of jurisprudence has evolved. And what do taxpayers require? Taxpayers require certainty to efficiently plan their economic behavior. You need to have some degree of certainty so that you can decide what to do and what not to do. Rowlett J. in Cape Brandy Syndicate versus IRC says that in a taxing act, one has to look merely at what is clearly said. There is no room for any intendment. Nothing has to be read in. Nothing has to be implied. One can only look fairly at the language used. Why do we say this? If you are a citizen of a country, if you are a taxpayer, if you are staying in some remote part of the country, you don't have great advantage of professionals. How will you decide what to do and what not to do? Only by reading the language of the law. Only by reading the language of the law. Because that is what you can do. And that is why a principle has evolved that it is the duty of government, it is the duty of parliament to write law in a clear-cut terms. Because otherwise citizen cannot decide his behavior. He can read, understand and do what is stated. That is the way you have communicated your intent. That is the way you have communicated your purpose of bringing a particular legislation. So language is very critical. And if you continue to draft your legislation in an ambiguous manner, and then you leave behind loopholes or otherwise, I think you suffer. Because if you don't write well, you should be penalized. And that is a penalty on government to that extent. But if you have not done it, the only way in which a citizen can decide his behavior is to read the language and decide what to do. Again, very interesting observation in IRC versus Fisher's executors. Again, these are interesting decisions going back to 1921, and IRC versus Fisher was 1926. My lords, the highest authorities have always recognized that the subject is entitled so to arrange his affairs as not to attract taxes imposed by the crown, so far as he can do within the law, and that he may legitimately claim advantage of any express terms of any omissions that can find in his favor in taxing acts. In so doing, he neither comes under liability nor incurs blame. Again, very well known decision in the case of Duke of Westminster, 1935 case. The principle continued to prevail. Every man is entitled, if he can to order his affairs so that the tax attaching under the appropriate act is less than it otherwise would be. Given that a document or transaction is genuine, the court cannot go behind it to some supposed underlying substance. See, substance was made such a big issue every time. Oh, you must have a substance. But what do you mean by substance? How can you get into, and what is substance? It becomes such a subjective matter at times. So, all that you have to look at, whether the documents are there. Are they genuine? That's all. Okay, you cannot go into other aspects. So this has been our jurisprudence. And the same principle, what we began to look at for last 100 years, okay, is same thing now restated by Supreme Court. Supreme Court has, in one sense, done nothing new. It has just restated what was the law and what has been the law, and how India has also practiced the law. Same thing has been repeated by the Supreme Court. Very interesting. If one scans through various judgments of the House of Lords in England, which we have already done, one thing is clear, that it has been a cornerstone of law that a taxpayer is enabled to arrange his affairs so as to reduce the liability of tax, and the fact that the motive for a transaction is to avoid tax does not invalidate. So if your motive to avoid tax does not invalidate the transaction, unless particular enactment so provides. So if you want to ignore form, you have to put it up in your legislation. If it is not there, you bear the brunt of it. Okay, and that is the same thing which we are talking about. So this is very, very interesting. Just one perspective that historically what we have done, I think it was not being followed by the tax department. Lot of chaos occurred. it was very difficult to figure out what is the cost of my doing business in India. That was a huge problem because you do not know. You do business and after 3 years you have tax assessment that, you go berserk. So, as I understand today, at least in the context of foreign companies, and I believe in cases of large taxpayers in India particularly, if I am not wrong and you are all in actual practice, 80 to 90% of the taxpayers suffer unnecessary litigation. The amount of tax that is being collected without what you call quote unquote, without the due authority of law. That means it is illegal exaction. You are collecting tax without the authority of law. It is illegal collection. And once the tax demand is raised, the stays are not granted. As you all know, almost in the first instance, you have like 34% tax, basic rate of tax on corporates, individual maybe 30. Effectively, tax rate in India is very high. 34% is what you call corporate tax rate. Then post-tax profits, if you distribute them by way of dividends, they are taxed at the rate of almost 17%, so effective tax rate of additional 10%. So it goes to 43 or 44%. But before you distribute dividend, you have to park almost up to 10% in the corporate reserve. They are general reserves, so it's one thing. So if you take 10% of the post-tax profits, that is about 66. 34% is tax, $100 is income, 66 is left, 10% goes to your reserves, so it's almost 60. If you declare 60 as dividend, then you pay another almost 10% tax. So close to 50% of your profits are blocked to start with. Because this tax is considered to be a tax paid by an Indian company, the dividend tax in particular, of course 34% corporate tax as well. Because this tax is paid by the company, you even do not often get tax credit for the taxes, paid in India. So if you declare these dividends, then again in the US, you may have to pay tax. So that tax could be up to 15% to 35%. So effective tax rate cascades to a great extent. And as far as the mechanism is concerned, if you see there is so much disallowances. What you find today is that when you have $100 tax return filed, your income you show is $100, by and large, say they don't know, your income is 200 or 300. It used to be like 10%, 20% disallowances. Now, the disallowances and additions are close to sometimes 100%, 200%, you have no limit to that. So, if you have 100% addition, that means your 34% tax becomes 68 effectively. At one point of time in India, we used to have 97.5% tax. And added to that, disallowance and wealth tax and stuff like that, tax is almost 102%. But from that, at least today we are much better off. And but the tax effect cumulatively, domestically and internationally, is fairly high. And therefore it becomes very important to plan your affairs, of course in a manner which does not violate law, it does not violate any laid down rule, and that is what we want to do. But so long as you play within the four corners of law, a taxpayer must trust a tremendous amount of litigation, I think. And this judgment has brought a lot of relief, not only to Vodafone, but also to many other taxpayers in our country. As I was mentioning that most of the large or most of the foreign companies, again, are continuously facing what you call tax litigation, tax controversies as they say overseas, So these tax controversies, what do? They effectively inflate the budget. So the budget numbers you see, the data you see in the budget, in my view, or at least I'm a layman, I'm not a brilliant chartered accountant like you all are here. But as I see from principal perspective, that this data integrity of the budget numbers you see is somewhat doubtful. So you do not know what is your real state, whether the budget gives you true and fair view of the financial affairs of the financial condition of a country. I am told that on account of transfer pricing adjustment, since it started, about 50,000 crores are in litigation. 50,000 crore tax in litigation. Now imagine today the ratio of success in appeals is close to 80%. 70-80% cases go in favor of taxpayer in the higher appeal, and then. So even if you say out of 50,000 crores, 80%, 40,000 or 35,000 crores are illegally collected. On the top of it, government will pay interest. Not only for 1 year, but for years together, for all these years. So we are putting ourselves in more debt trap. But this is only on transfer pricing. What about others? I think our budget must show separately how much tax has been collected, of which how much tax is under dispute. That should be a separate item. Otherwise, there would be a misrepresentation of the accounts of the country. Okay, and you are making huge decision either to make investment or to spend somewhere else for poor people or otherwise, but you are putting the country in a debt trap or internal debt trap or even external, because Vodafone 4% interest is being paid to a foreign country, right? And that would be going out of the country and it is going out of our pocket. So I think this is a broad background as to why it is important to collect taxes with lot more care. Government owes more duty. It cannot behave like normal taxpayer. We can always discuss separately. But this is a broad background which implication, at least to some extent, I think this ruling brings a relief. Now let's quickly go into the facts of the case, but I am not going to go into too detail because it is very complex. On page 6, you have a structure. You can see on the top you have Vodafone International Holdings PV, you got CGP Investment, and you got Hutchinson Telecom, which is shown in greenish color, and the share purchase agreement of $11.1 billion. Okay. Maybe if you want to say simpler structure, there are about 30 different entities, or maybe even more in this. Okay. And there is some relevance because all these structures, when they are done, how has court looked at it? With the number of holding companies, subsidiary companies, and stuff like that. So, and at the bottom you can see Hutch SR Limited, Vodafone SR Limited. So next page on 7, or slide number 7, shows a simplified version. Okay. So the transaction in nutshell. So removing all the clutter around. In the blue box, you can see Hutchinson Telecom International Limited, HTIL, Cayman company. Of course, on the top of it, there was a Hong Kong company. Then you have Vodafone International Holdings BV, a Dutch company, which purchased the shares under what called SPA, a share purchase agreement, for $11.1 billion. This HTIL, it had intermediate BVI companies, all 100% owned. And below that, there was CGP Investment Holdings Limited, Cayman Islands. It's in a pink box. So the shares of CGP Investments were sold to Vodafone International Holdings BV, Netherlands. Okay. And this CGP investment and again subsidiaries all the way going into Mauritius subsidiary and again holding those shares in holding shares in Indian company Vodafone SR. See, at the bottom there was a Mauritius company as well. So in nutshell, Hutch could have also sold shares of Indian company directly from Mauritius. Now what happened? The next page 8. What was revenue's case? Revenue's case was that consideration paid by Vodafone, which was the purchaser, to Hutch is taxable in India because in substance it led to the transfer of interest and business in India. So underlying assets of this company was transfer of business in India, and therefore when you transfer the shares of the Cayman company on the top, you are actually selling not the shares but the underlying asset. That was in substance. And Vodafone should have withheld tax on the transaction. When I talk to most of the people overseas, they are always surprised that how can a purchaser be liable to deduct withhold tax? Nowhere it happens in the world. But this was the issue that Vodafone was expected to withhold tax before making payment of this purchase price of $11.1 billion. Maybe this is the broader context. What were revenue's arguments? Why they felt or they say that this transaction is taxable? Maybe what I would like to do at this point in time is to ask Mahesh to just set out what were the arguments of revenue to tax this particular transaction in terms of capital gain. So Mahesh, can you?
Sure. Thank you, Mr. Rai. In fact, I think I'll be a little brief because in the interest of time. And so essentially, the revenue tried to evoke the sentiments of the court. They said that, okay, here you have $11.1 billion transaction. A transaction between a Dutch company and a company based in the Cayman Islands. Now, the revenue argued, you're obviously not paying $11.1 billion for the transfer of one share of another Cayman Island company. Because essentially, the SPA, the share purchase agreement between the Dutch company and the Cayman Islands, the seller in the Cayman Islands, was for the transfer of a single share of a Cayman Island company. So the revenue said, obviously, it was not a transaction where the parties intended to sell only one share of Cayman Island company. There was definitely something more to it. So they looked at a whole bunch of documents. They looked at board resolutions of various subsidiary entities. They looked at due diligence findings, and then they identified that it's not just one share of this Cayman Island company. There were a whole bunch of rights that were transferred. Now we'll come to those rights in page number 10. But essentially, the argument was that $11.1 billion was paid for the acquisition of controlling interest in the Indian company, controlling interest and an indirect stake of around 66.9% in the Indian operating company. So this was an indirect transfer, and hence India has the right to tax it. So that was as simple as their argument can get. That implies that all these rights, which we'll come to in the next page, in the next slide, all these rights are distinct capital assets. Although the SPA contemplated transfer of one share of Cayman Island company, these rights in relation to the Indian company have been also transferred as part of the transaction, for which a consideration of $11.1 billion has been paid. These rights are separate capital assets. They are situated in India, and hence India has a right to tax this. Now, this is what the Supreme Court has referred to as the dissecting approach. They have dissected the entire transaction. They've looked beyond the SPA, the share purchase agreement between the Dutch company and the Cayman Island company. They looked at all ancillary agreements. They tried to look at the whole the structure as a whole. Then they identify each of these rights. Now, if we go to slide number 10, I'll quickly go through the specific rights that the revenue has alleged has been transferred in this case. So apart from that one share of the Cayman Island company, they said we paid $11.1 billion for the indirect equity interest in the Indian company, the right to do telecom business in India, the right to take advantage of the telecom licenses, the right to use the Hutch brand. Obviously, it was a royalty-free trademark, but still they said that is part of the consideration. They said it involved the right to appoint directors, so in a way to manage and control the Indian entity, the right to take part in key decision making in the Indian company, the rights in respect of certain loans and advances between the various subsidiary entities, the right to exercise various put and call options, right, the non-compete rights, consultancy support, and various other intangible rights. So the idea, the argument was that this entire bundle of rights was what was contemplated by the parties who entered into the transaction. So obviously, this is what we need to look at. We should not just stop at the SPA. India, the tax department or courts are entitled to look at the substance of the transaction, which was the transfer of all these rights, which according to the revenue was situated in India, represented capital assets, and represented Indian source income, and hence this $11.1 billion consideration should be taxed in India. So,
yeah. And I think just to step back for a moment and explain to you a little bit on this revenues dissecting approach. Essentially, what department tried to say that you are not transferring one share. First of all, in terms of lessons, of course, just a bit of perception. There's only one share in $11 billion. It's too much. They could have perhaps had 100 million shares issued at a 0.0000 something cent, okay, per share. Then it would look great. Okay, 100 million shares purchased for. So perceptionally also, when judges are often not very familiar with tax concept international, now that jurisprudence is improving, sometimes this becomes cosmetic. So one lesson sometimes you learn is that when you do it, not only take care of what is legal, but also see that how it will be perceived. Okay, of course you have all the right in the world to do it, whether one share or 100 million shares, the same thing. It's how, but the perception sometimes changes, and I think we have to bear in mind that often you may confront judges who are not familiar with. But one good thing that has come out is that at the end of the day, they are smart enough to understand what the real situation is. Now coming to dissecting approach, what department tried to say that when you transfer share, you are transferring number of different rights individually. Okay. Let me explain to you in a simple way that when you own a land, what is ownership? Ownership is bundle of rights. You right to lease, you have to right to build, you cannot dissect all these rights. As I transfer my ownership, it means all the rights are transferred. Then you don't go into valuing, oh, this would be so much, this one will be so much, and this is right, this is right. Correct. It's a one single right. That's the simplest way I could possibly explain the dissecting approach. Same way for shares. Shares, when you transfer, you are not transferring assets of the company or underlying assets of the company. So, in terms of jurisprudence, we all understand that share is a separate asset from the assets of the company, and you cannot mix up the two. But revenue took that approach that look here, this right, this right, this right. So I went on narrating and saying that all these rights have been transferred. Okay, and court had to look into what the correct position in law. So may I think request Dhruv to tell us what was Supreme Court's verdict. Of course, you all know that, but little bit more specific terms.
Thank you. I think the verdict was that Vodafone, you don't need to pay any taxes, but the judgment did, of course, lay down far greater principles of far greater impact to a lot of other taxpayers as well. I think the first, if we are at slide 12 for those who are not physically present with us.
11, slide 11.
I'm sorry, yes, slide 11, right. Thank you, pardon. So it says revenue does not have jurisdiction against Vodafone. offshore transactions per se are not sham, unless and until, of course, they are there is a colorable device which is used. You cannot say that it is not bona fide. That the revenue was not justified in disregarding the form of the transaction. Interestingly, and correctly according to me, they also said that the burden of proof on proving that a particular transaction or a structure is a sham must be on the revenue. Because you cannot disprove what cannot be proved. And if you put the burden on somebody as to something that cannot be proved, and it is very difficult for that person to disprove something which cannot be proved in the first place. So there were no rights or entitlements in India that HTIL or Vodafone International, which was the BV in the Netherlands, had on their own account, or CGP for that matter. And there is no explicit provision of law which permits the taxation of the transfer of the underlying interest, so to say. And of course, the verdict was Vodafone is not liable to tax in India. We could probably go ahead with a little bit of what the judgment said. The verdict was, of course, applicable only to Vodafone. But what would be of interest to others is you cannot look through a transaction or an arrangement or a structure. You must look at it. Unless and until, of course, there is a sham or a colorable device. Now, the look at approach that the Supreme Court is talking about was based out of Section 9.
On page 12.
Yeah, we're at slide 12 now. Was fundamentally reading Section 9(1)(1), wherein they said capital gains would be liable to tax in India if they are directly or indirectly, if they directly or indirectly accrue from the transfer of a capital asset situated in India. That is what Section 9(1)(1) says. Can this be read to mean that income accruing or arising from the direct or indirect transfer of a capital asset in India, they're two different things? And the Supreme Court very clearly held that Section 9 is not a look-through provision. So there is no explicit legal basis to look through a structure in the Income Tax Act. So you must look at a transaction. However, of course, you cannot disregard shams. So not for a moment are we suggesting that blatant tax evasion should be tolerated. And when is a transaction sham? When is a transaction a colorable device? Is something I think we'll discuss in a bit. But when it is not, is what the Supreme Court has certainly mentioned, insofar that you must look at a transaction in a holistic fashion. You cannot dissect a transaction, as Nishith has already pointed out, to say that, well, to speculate, I would go to say, as to what were the reasons behind paying this consideration for one share. It is because there is an underlying interest. You cannot dissect and in order to speculate what the purpose of a transaction was. The criteria, there was a twin test that the Supreme Court laid down in determining whether there was a bona fide transaction. Number one was whether there was continuity in an arrangement. And number two, was there a business purpose? If one looks at bullet point number 4, the last one over here, it says continuity of business until exit. What is business purpose? But is our structure is preordained at merely getting a tax benefit in India? And or is it intended toward participating in the Indian economy? If it is for the purpose of participating in the Indian economy, there is business purpose. Of course, duration of the holding structure, it ought not to be a fly-by-night structure. There has to be a certain period of business operation that has to be looked at. And of course, if a structure is generating taxable revenues in India throughout its lifetime, one cannot say that this is aimed at tax evasion. Of course, in Vodafone, there's a section when they've said that the Hutch had paid thousands of crores of rupees in taxes in India while it was operating. it certainly cannot be said to be a tax evasive arrangement. Exit rights is another important right that the Supreme Court has underscored in this judgment. It said that the purpose of doing business is to extract profit. Now, one is the business operations and the other is exiting. If I have conducted business in India, I have paid all my taxes, and thereafter, does that mean that while exiting, I must give up my profit motive? Certainly not. And if there is an arrangement which is aimed at avoiding double taxation or onerous taxation which would wipe out the entire basis of my doing business in India, then I have the right to arrange my affairs so as to return profitable to my shareholders. And therefore, a structure which is aimed at a tax efficient exit, that structure cannot be said to be dehors of business purpose. And in such cases, one cannot fleetingly pierce the corporate veil. If we move on to slide 13, it essentially encapsulates the number of reasons that would justify a structure and what would infuse business purpose. One could have an elaborate horizontal or vertical structure to improve corporate governance, to improve operational efficiency, ring fencing of legal liabilities, hedging of business risks, consolidation, leverage, mobility of investments, tax efficient structures, of course, to prevent double taxation, and efficient exit routes, and maximizing value to shareholders. The very purpose of company law is to create a legal fiction of duality between a business and the owners of a business. We could move on to slide 14 for this purposes, which talks about the importance of respecting the corporate veil. It was the 1897 appeals cases in Solomon versus Solomon, wherein they said that the company and shareholder, even if it's a 100% owned company, are indeed distinct legal entities and having distinct personalities inter se. So even if a parent company owns 100% of its subsidiary, it is through the operation of law that that subsidiary has been created. You cannot disregard the duality of these two entities. Even if the subsidiary receives all the funds from its parent company, this is bound to happen if it's a 100% subsidiary. The parent exercises shareholder control and specific management rights over a subsidiary. Essentially, all these rights that have been discussed in the second bullet point on slide 14 are all legal rights. Whatever has been granted to the shareholder, as far as it is through the operation of law, it cannot be said to be abusive. You cannot, on the one hand, give certain rights, and on the other hand, take it right back. The decisive criteria to know whether there is an abuse of law is, of course, does the parent exercise, quote, such steering interference with the subsidiary's core activities that the subsidiary can no longer be regarded to perform those activities on the authority of its own executive directors. If it's a mere conduit, which only acts as per the directions of the parent company, and there is no independence whatsoever and acts as a mere alter ego, as the Supreme Court has pointed out, there might be reason to look into the structure and examine whether one can disregard the corporate existence of the subsidiary. Very interestingly, I'd like to add, Mr. Chairman, is that if something that the Supreme Court has not dealt with, in the case of Barcelona Traction and LC, which were decided by the International Court of Justice, it said that a company is essentially an animal of law, and that law and the laws that bring this animal into existence are essentially territorial to the country to which the laws belong. Is it for the courts of another country to interpret the laws of the country under which the corporate existence is regarded? To interpret these laws and say, well, we are going to disregard the laws of another country. That flies in the teeth of territorial sovereignty of the other country itself. And I think that is another aspect that needs to be looked into when one looks at cross-border lifting of the corporate veil. I think
Absolutely. I think in short, what Supreme Court has said is that by definition, company is an artificial entity. Okay, all of us know that, right? It's artificial. And behind every company there is always an individual, right? From Salman's case, you see, even if you are single shareholder, okay, even if you hold one share and you got $11 billion asset underneath, still company is a separate entity. I think this fundamental principle is so clear and often we confuse. So all that Supreme Court has said that once you have a company, you have to recognize what I would call artificiality. So it is artificial. By definition it is artificial, but still law has conferred on it a personality, a separate legal personality. And that is what you have to respect. So there are very extreme circumstances under which you can lift the cause, lift the corporate veil. So that is a very, very critical important. Otherwise, every case you can easily say, oh, who is behind this? Somebody. So there is always somebody behind. Ultimately, it goes back. John Preble, one of the top professors of the New Zealand University, Victoria University in New Zealand, he once said in last IFA conference that by definition, behind every company, there is some individual at some point in time. So you cannot just ignore that. Okay. So I think Supreme Court has recognized that, and that is big relief, so that you are able to set up your holding company, subsidiary, and there could be a number of reasons, as was pointed out earlier. It could be corporate governance, it could be operational efficiency, consolidation, mobility of investment, tax efficient, even to avoid double taxation, exit route. There could be n number of reasons why you can set up subsidiaries, and that itself is a business purpose. But coming back to all these observations that Supreme Court has made, okay, what is the permissible behavior for taxpayer? How should taxpayer behave? There is also some interesting jurisprudence that is coming out of this judgment, and maybe Mahesh, would you like to take this?
Sure, thanks. So we all know that so the Supreme Court has held very clearly that you can't really pierce the corporate veil, especially in many of these cross-border holding structures. There are genuine business and commercial reasons why they're set up. So courts have to be very careful, very cautious while piercing the corporate veil, while disregarding the form of a transaction. So the principle is that all taxpayers are entitled to plan their affairs within the four corners of the law. And it's a principle, as Nishith Desai has said, it has been there for the last century, and it continues to be fully enforced. So the question is, now, what exactly is the takeaway for taxpayers? After this decision, are taxpayers in general, are they better off? Do all of us, taxpayers worldwide, do we know what exactly is permissible taxpayer behavior? Now, Supreme Court said that, yes, you can plan your affairs within the four corners of law. The tax department will respect the form of your transactions, but not if it is a sham or a colorable device. Now, what is a sham? What is a colorable device? Now, Supreme Court has not really defined these terms. They've used it as a manner of saying, but they have said that certain transactions. For example, you have, say, round tripping. People sending money outside India, it coming back into India, trying to artificially take advantage of some tax treaty. They said that round tripping is an example of a sham. And even something like circular trading. For example, there was this very famous House of Lords case of Ramsay, which has been part of this entire jurisprudence on tax avoidance. So there, where a taxpayer earned certain profits from a sale and leaseback transaction, and then just for the purpose of eroding this profit, they went into certain circular loan obligations with a financing house and artificially created deductions. So now that is what was treated as a sham. So then the Supreme Court also indicated that if you have a holding structure with no business purpose, absolutely no business purpose, and the only reason for having this structure is to avoid tax. That could also be considered a sham. Of course, that is quite broad, and we'll discuss in terms of whether that creates any uncertainty. We'll discuss that towards the end of the presentation. Now, to understand what is sham, the best, possibly the best definition was given by the UK Court of Appeals in Snook versus London, where they said that a sham transaction is one where it means acts or documents executed by the parties to the sham, which are intended by them to give to third parties or to the court the appearance of creating between parties legal rights and obligations different from rights and obligations which the parties intend to create. So in essence, your documents say one thing, but in reality, you're doing something else. The question is, what is a colorable device? Now, again, a colorable device as such has not really been defined generally. But then there was a court we were able, a case which we were able to pick up, where there is a vague definition of what a colorable device is. This is the Delhi High Court. It said that a colorable transaction is one which is seemingly valid, but a feigned or counterfeit transaction entered into for some ulterior purpose. So again, a facade. You say your documents say one thing, but you're doing something else. So essentially, a sham transaction or a colorable device normally can be used interchangeably. But still, is there real clarity? With these definitions, do all of us know what exactly is a sham or a colorable device? But what we do know is that the Vodafone Hutch structure was not a sham and was not a colorable device. And that is something which the Supreme Court has held very clearly. And the question is, why is this Vodafone structure or this Hutch, this entire acquisition structure, why is this not a sham? So the Supreme Court, if we move to slide 16, slide 16. No. So if we move to slide 16, Supreme Court, so here we've identified the specific reasons why the Supreme Court concluded that the Hutch structure was really not a sham. So they applied this look-at approach, which Dhruv just explained. Look-at approach as opposed to a dissecting approach. They said, don't dissect all these transactions. We are not interested in all these 100 documents and other transaction disclosures to FIPB and valuation reports and due diligence reports. We are interested in the overall transaction. What exactly happened? So then they looked at the entire history of the Hutch group. The entire Hutch structure can be traced down almost 20 years, since 1994. They noted that the Indian entity, so Hutch invested significant sums into India, grew the entire telecom business. The Indian entity paid around 20,000 crores over the years in both direct and indirect taxes. And then even after the transaction, Vodafone steps into the shoes of, as a group, steps into the shoes of Hutch. The business continues. They also noted that the various, you must have seen the various 30 subsidiary entities in the entire structure in Mauritius and BVI. So the tax department has been saying all these are puppets. They're just being controlled. The court said no, they're not puppets. The top tier companies do not have a direct control over the. You can exercise control by your shareholder control or indirectly by appointing a nominee director, but that is not the control which can allow you to disregard the subsidiary. That is not the kind of control which will allow you to conclude that the parent and the subsidiary are one and the same entity. So they say that although the parent companies may have had some sort of certain rights in respect of the subsidiaries, say for example they had the right to finally determine who is going to be the CEO, chairman of the Indian company, the fact is this was not a legal right. These rights were actually held by other entities. And it was more of a persuasive right because you are functioning as a group. So the entire idea of this SPA was to ensure a smooth transition from Hutch to Vodafone. They even looked at each of these rights. They said that the court concluded that these rights are really not distinct capital assets. These rights are all inextricably linked to the shares. So when the Cayman Islands company seller sold the shares of another Cayman Islands company to the Dutch company, they could never have transferred any of those rights, those 14 rights which the revenue has identified. All these rights actually vested with another entity. And secondly, these rights can never be split from the shareholding. So by transferring the share of the foreign company, you could never transfer all these rights which are in relation to the Indian company. So this was the conclusion of the court when they applied this look at approach. Now, if we move to page slide number 17, we'll go through what exactly. So based on these findings in terms of the Hutch structure, the fact that the Hutch structure had the entire structure was based on bona fide purposes, business purposes. It was the court concluded that this transaction was nothing but the sale of shareholding of a foreign company. Now, Vodafone had prior to this acquisition, they had gone to the FIPB, the Foreign Investment Promotion Board, just to inform the Foreign Investment Promotion Board that this massive investment is being made. So then the FIPB asked the parties, what exactly are you paying $11.1 billion for? So then they said that we are acquiring these rights, these non-compete rights, the right to acquire these controlling interests, and they broadly indicated these were the elements that went into this valuation. And this was something which the tax department very heavily relied on. They said that you yourself are admitting that you transferred all these rights. Why shouldn't I tax you? The court said that what should we look at for tax purposes? Do we look at this FIPB disclosure? We have to respect the form of the transaction. Form of the transaction is contained in this SPA, the share purchase agreement between the Dutch company and the Cayman Islands company. What did the SPA want? The SPA was all about the sale of the shareholding in a foreign company. And then there were other arrangements with a view to ensuring the smooth transition from Hutch to Vodafone, which was inevitable. But the fact is, the dominant intention of the contracting parties was to transfer the shares of a foreign company. So the idea is, so since this was a contractual intention, you do not disregard this contractual intention, especially since there was no sham in the structure. The structure was not a sham, the structure was bona fide. A large group made genuine investments into the country, decided to exit. Another large group decided to acquire this business and continue this business. Now, it was decided that this consolidated payment of $11.1 billion is paid for this acquisition. The tax department cannot go dissecting this consideration, saying that it was made for this right, that right, or whatever right. So the Supreme Court, as such, respected the contractual intention of the parties. They said that the transfer of the shareholding in this foreign company, in this Cayman Island company, did not give rise to the transfer of any capital asset in India, and hence this transaction is not taxable in India. And since it is not taxable in India, the buyer, Vodafone, did not have any obligation to withhold tax on this transaction.
Yeah. I think one or two points on this subject. You talked about round tripping.
Yeah.
Again, don't take these words very literally, because round tripping is most common in the world, but there is something called legitimate round tripping and something illegitimate. For example, there is a US company. Okay, it has set up a subsidiary company in India, software company. Software company again sets up a branch in the US or sets up another subsidiary in the US. It is also round tripping. So round tripping also has different connotations. Round tripping per se is not illegal even today. You know, it happens all the time. But the connotation was given by the press sometimes, or by some courts or some people. Oh, round tripping, and therefore that became a bad word. But round tripping, there is nothing wrong. Okay. Yes, where round tripping becomes relevant and as they say, circular trading. What does that mean? It means that when you enter into more like self-cancelling transaction. Okay, many of you know, like if you take section 65, it is not a judgment, I'm just explaining. Like you tell your brother that I give 1 lakh of rupees gift to your son, because at that time when we had a gift tax, okay, and you give my son 1 lakh of rupees gift, okay, so it becomes self-cancelling kind of. If there is a time interregnum between, it's different. But on the same day or very short interval, then really speaking, you're not making gift because there is understanding between the two parties. Okay, I give gift to your son, you give to my son and stuff like that. So when you talk of round tripping or circular trading, basically it would have effect of what you call some kind of self-cancelling transaction. That's one point I thought I'll just add to what you added. And of course we'll discuss more. But let us.
There's just one point which I missed in terms of the justification why the structure was not a sham. Now,